Right now, something unusual is happening in the global financial system, and almost no one is talking about it the right way. Central banks, the biggest players in the world, are starting to make moves that are confusing investors everywhere. Some are buying gold aggressively, but others, like Turkey, are suddenly selling gold. And that's raising a serious question. Is this the beginning of the end for gold and silver? Or is it actually the signal of something much bigger? Because at first glance, it looks bearish. A country selling gold? That sounds like weakness. That sounds like the bull market might be over. But here's where most people get it completely wrong. What Turkey is doing is not abandoning gold. They're using it. They are selling gold temporarily to support their collapsing currency, the Turkish lira, trying to create demand and stabilize their economy. And that changes everything. Because it reveals something critical that most investors don't fully understand. Gold is not just a store of value, it's also a liquidity tool. It's something countries can quickly sell when they're in trouble, to defend their currency, stabilize markets, and buy time. And that actually strengthens the case for gold, not weakens it. Think about it like this. If gold was useless, central banks wouldn't be relying on it in a crisis. But they are. And not just small countries. Even major economies are quietly positioning themselves around gold. Now here's where it gets even more important. This situation is exposing a much bigger problem, one that goes far beyond just Turkey. Because this isn't just about one country struggling. This is about a global system under pressure. We're now living in a world where total global debt has crossed over $100 trillion. And the real issue? It's not just private banks anymore. It's entire countries. Sovereign nations are now facing the kind of pressure we used to only see in financial crises like 2008. Back then, banks were the problem. Today, governments are. And that's a massive shift. Because when banks were in trouble, central banks stepped in and printed money to save them. But now, the ones who print the money are the ones in trouble. Let that sink in. And this is where things start to connect with gold and silver in a very powerful way. Because when confidence in currencies starts to weaken, when debt becomes too large to manage, and when governments are forced to sell assets just to survive, investors start asking one question: where is real safety? And historically, there's only been one answer: gold, and increasingly, silver. Now here's another detail that most mainstream media is barely talking about. While Turkey has been selling gold, they've also been dumping something else, in even larger amounts. US Treasury bonds, billions of dollars worth. And this is critical, because if countries begin to lose confidence not just in their own currency, but also in US debt, that could trigger a much bigger shift in global markets. A shift that impacts currencies, interest rates, and ultimately, your purchasing power. And this is exactly why what's happening right now is not just another news story. It could be the early stage of a much larger financial transition. A transition where money starts moving out of traditional assets and into hard assets like gold and silver. Because once you understand what's really driving this market, the entire picture starts to change. Right now, a lot of people are focused on headlines: war, interest rates, job reports, geopolitical tension. And yes, those things matter in the short term. But they are not the real drivers of what's happening in gold and silver. They're distractions, temporary noise. The real story is happening underneath the surface, and it comes down to one powerful shift. Money is starting to move. For years, over a decade, most of the world's capital flowed into one place: stocks. The US stock market especially became the center of global money. Tech stocks exploded, indices kept hitting new highs, and investors got comfortable. Too comfortable. Because when one asset class dominates for that long, it usually means something else is being ignored, undervalued. And that's exactly what happened with commodities. Gold, silver, oil, copper, all of them were underpriced for years compared to stocks. And now, that imbalance is starting to correct. We're beginning to see early signs that money is rotating out of stocks and into commodities. And this is a critical moment, because these types of rotations don't happen overnight. They build slowly and then suddenly accelerate. Now here's where things get interesting. Even with all the recent volatility, gold has remained strong. Yes, we saw a correction, but it was sharp, quick, and very controlled. And that's actually a bullish sign, because in strong bull markets, corrections don't last long. They shake out weak hands, and then the trend continues. And according to long-term market analysis, the trend for gold is still intact. In fact, it hasn't even come close to breaking, which tells us something very important. This move is far from over. Now let's talk about the stock market for a second, because this is where things could start to shift dramatically. There's growing evidence that the stock market may be entering a topping phase. Not a crash overnight, but a slow, grinding process where momentum weakens and upside becomes limited. And historically, when that happens, money looks for a new home. And one of the biggest beneficiaries of that shift has always been gold. But here's the twist that most people don't expect. Gold doesn't always wait for a full stock market crash. Sometimes it starts moving before it. And that's what we may be seeing right now. Now think about this. Back in 2008, during the financial crisis, gold didn't collapse permanently. Yes, it dropped briefly, along with everything else. But then it exploded higher, from around $700 to $800 to nearly $1,900 within a few years. And silver? It went even further. That period, from 2009 to 2011, was one of the most powerful moves in precious metals history. And here's the key idea. Some experts believe we are not at the end of that type of cycle. We may actually be at the beginning of a similar phase again. A phase where gold rises steadily, but silver moves much faster. And if that's true, then what we're seeing right now is not the peak. It's the setup, the foundation for a much bigger move. Now add one more layer to this. The global monetary system itself is starting to show cracks. Currencies are losing purchasing power, debt is increasing, and central banks are quietly preparing for what comes next. And when all of these forces come together, that's when markets don't just move, they shift, move forward. Because in the next part, we're going to dive into silver specifically, and why it could outperform gold in a way that shocks most investors, with price targets that very few people are prepared for. Because now we need to talk about the one asset that could completely shock this market: silver. Most people look at gold as the safe haven, and that's true. But when real bull markets begin in precious metals, silver is where things get explosive. And right now, silver is sending signals that very few investors are paying attention to. Let's start with something simple. Gold has been making higher highs over the years, from around $250 to $800 to $1,900, and now pushing even higher levels. That's a clear long-term uptrend. But silver? It's a completely different story. For decades, silver has been stuck, capped, held below major levels, especially around the $50 range. Think about that. While gold kept breaking into new territory, silver kept hitting the same ceiling again and again. And that creates a very important setup. Because when an asset stays underpriced for too long, it doesn't just slowly catch up. It tends to correct aggressively, sometimes violently. Now compare silver to something like copper. Copper traded in a tight range for decades, just like silver. But when it finally broke out in the mid-2000s, it didn't move slowly. It exploded, multiple times higher within a short period. And now, many analysts believe silver is setting up for a similar move, but potentially even bigger. Because silver isn't just an industrial metal, it's also a monetary metal. It moves with gold, but with more volatility, more speed, more upside, and yes, more risk. Now here's where things get really interesting. If you look at the gold to silver ratio, which simply compares the price of gold to silver, silver is still extremely undervalued. Historically, silver used to trade at a much stronger relative level compared to gold. In past cycles, it reached around 3%, even up to 6% of gold's price. Today, it's sitting close to around 1.5% to 2%. That's a massive gap. And markets don't like gaps like this. They tend to correct them fast. Now imagine what happens if that ratio starts moving back toward historical levels. It doesn't just mean silver goes up, it means silver could outperform gold significantly. And this is where the bold predictions come in. Some analysts are now talking about silver reaching levels like $150, $200, and even more aggressive targets, $300 to $500 per ounce. Now I know, that sounds extreme, but let's break it down logically. The global money supply has expanded massively over the past decades. Every 10 years, more currency is created. More liquidity enters the system. But silver hasn't reflected that expansion. It's still trading as if the world hasn't changed. And that disconnect is exactly where opportunity comes from. Because when markets finally adjust, they don't move slowly, they overshoot. Now here's another key point. Silver's recent correction was very sharp, but also very short. Most of the drop happened in just a day or two, and since then, it hasn't made new lows. Instead, it's been stabilizing, building a base. And in strong markets, that kind of behavior usually signals one thing: the correction may already be over. And if that's true, then the next move could catch a lot of people off guard. Because once silver breaks key resistance levels, there's very little standing in its way. And when momentum kicks in, it tends to move fast, much faster than most investors expect. Because now we need to connect all the dots: gold, silver, the stock market, and the global financial system. When you step back and look at everything together, a much bigger picture starts to form. This isn't just about metals going up. This is about a shift in where money flows in the world. For years, the stock market has been the main destination. Trillions of dollars have gone into equities, pushing valuations to historic levels. And now we're looking at something very important. One of the largest and longest stock market cycles in history may be reaching its limits. Not collapsing overnight, but slowly losing strength. And when that happens, capital doesn't disappear, it moves. The question is, where? And right now, all signs are pointing toward commodities. Gold and silver are leading that move, but they're not alone. Oil, copper, agriculture, the entire commodity sector is starting to wake up after years of being undervalued. And there's a reason for that. Because when central banks face pressure, when debt becomes too large, and when financial systems start to strain, there is only one solution they always go back to: printing more money. Liquidity. Stimulus. And while that may stabilize markets temporarily, it comes with a cost. It weakens the value of currency over time. And when currencies lose value, real assets gain value. That's why gold rises. That's why silver follows, often even faster. Now here's where things get even more critical. In past crises, like 2008, central banks had more control. They could cut rates, print money, and support the system. And it worked. But today, the situation is different. Because now, even the bond market is under pressure. Government debt levels are extremely high, yields are rising, and central banks are being forced to step in just to maintain stability. But here's the problem. Even when they step in, it's not fully working. Bond markets are still struggling. Confidence is slowly weakening. And this creates a dangerous cycle. More intervention leads to more money printing. More money printing leads to weaker currencies. And weaker currencies push investors toward hard assets: gold, silver, commodities. Now think about what happens if this continues. If stock markets start declining, if bonds remain unstable, and if currencies keep losing purchasing power, there's only one place left for large amounts of capital to go. And when big money moves, markets don't just rise, they surge. This is why some analysts believe the next few years could see one of the biggest commodity booms in decades. Not just a small rally, but a full cycle shift. Now let's bring this back to something very practical: investments. Because a lot of people are asking the same question right now: where should I be positioned? And one area that's getting increasing attention is mining stocks. Gold miners, silver miners. These companies are directly tied to the price of metals. And historically, when gold and silver move higher, mining stocks can outperform even the metals themselves. Now here's what's interesting. Even recently, while the broader stock market has shown weakness, some mining stocks have actually held up better than expected, in some cases, even outperforming. And that's a very strong signal, because it suggests that money is already starting to rotate into this sector. But there's another side to this: energy, oil. Because oil plays a major role in the global economy. And while oil has strong long-term fundamentals, right now, it may be more sensitive to short-term events, especially geopolitical headlines, which means it could still see volatility before making a sustained move higher. So the key takeaway here is simple. We may be entering a phase where commodities lead, but within that space, not everything will move at the same speed. And that's where positioning becomes critical. Because now we come to the most important question: what happens next? After everything we've discussed, central banks, debt, currencies, gold, silver, and the shift in global money flow, where's this actually heading? Let's start with gold. If we look at previous bull markets, gold doesn't just rise slowly. It moves in phases. It builds momentum, consolidates, and then makes a powerful push higher. In the 2000s cycle, gold went from around $250 to nearly $1,900. That's not a small move. That's a massive revaluation of what gold represents in the financial system. And if a similar cycle plays out again, Some projections suggest gold could reach levels far beyond what most people expect today. Not just $3,000 or $4,000, but potentially much higher over time. Now bring silver into the picture, because this is where things could become even more dramatic. If gold continues rising, and the gold-to-silver ratio starts correcting back toward historical levels, silver doesn't just follow, it accelerates. That's why some analysts believe silver could reach $150, $200, and in more aggressive scenarios, even $300 to $500. Now again, that may sound extreme, but remember what we discussed earlier. Silver has been underpriced for decades. And when markets correct long-term imbalances, they don't move in a straight line, they overshoot. Now here's the part most people don't think about. If silver does reach those levels, it's not going back to where it was before. Yes, there will be corrections, there always are, but the baseline, the new normal, shifts higher. Just like gold never went back to $300 after its last cycle, silver may not return to those lower ranges again once it breaks out. And that changes how you think about the entire market, because this is not just a trade, this is a transition. A shift from a system driven by confidence in paper assets to one driven by real, tangible value. Now let's talk about risk, because this is important. Nothing moves in a straight line. Even in strong bull markets, there are pullbacks, volatility, moments where it feels like the trend is breaking. And that's where most investors get shaken out. They enter late, panic during corrections, and miss the bigger move. So the key is not just knowing where the market might go, it's understanding the journey, being prepared for volatility, and staying focused on the bigger picture. Now let's bring it all together. We have a global system under pressure from massive debt, central banks being forced into more liquidity and intervention, stock markets potentially reaching a long-term top, and commodities, especially gold and silver, starting to gain momentum. All of these factors point toward one thing, a major shift in financial markets. And if that shift continues, the biggest moves in gold and silver may still be ahead, not behind. So the real question is not whether gold and silver will move, but whether you are positioned before that move happens. Because once momentum truly kicks in, it doesn't wait. And by the time everyone is talking about it, the biggest gains are already gone. Before we wrap this up, if you found value in this breakdown and want to stay ahead of major market moves like this, make sure to subscribe to Gold and Silver Updates and stay connected with every update. Because in times like these, information isn't just power, it's an advantage. And in this market, that advantage matters. See you in the next one.